Hey, what's up? Jason here. Today I'm going to be talking to you about Exxon Mobil Corporation, and I'm also going to be talking about book value per share and how to find competitor information and how to use that information. So I'll go to webcam. So book value per share is essentially how much you would get per share if the company sold off. So in general, the higher the book value per share, the better. And what you should also be looking for is a trend of an increasing book value per share, as it shows the company's ability to reinvest in the business and to do so profitably and get a good return on equity, usually. So let's go to ExxonMobil. So if you see here, I have ExxonMobil on two tabs. I have it on MSN Money as well as Yahoo Finance. So if you go to ExxonMobil, we'll start with key ratios. Go to 10-year summary. And if you look here, you can see their book value per share. So if you look at their book value per share, you can see it's consistently rising, and it's at 36.84 for a price of 94.68. So although that isn't too high of a book value per share, you can see a good steady increase, which is a good sign. You look at their debt to equity, it's very low. That's another good sign. And look at their return on equity. It's super high, which is really, really a good sign. All right, so if you go to quote, take a look at the price to earnings, 12.04, which is pretty low. Go to the income statement. You check out their net income. You can see it was pretty high at 2008. It dipped a lot in 2009, probably because of the financial crisis. It rose up, and now it's back to 44,000. Now I also have here Exxon's financial statement for 2007, 2006, 2005. So if you look at it, in 2007 it was around 40,000, 2006 39,000, 36,000. So you can see this is around their normal levels, which they are returning to. So these are around their normal levels. If you look at their statement of cash flows, you can see positive cash flows from operating activities. That's a good sign. Negative cash flows from investing activities, and negative cash flows from financing activities. So that's a good thing. And you can also look at their issuance of common stock. So they've actually been buying common stock back, which is a good sign. If you go to their balance sheet, put it on annual, more interested in that. So let's look at their short-term position. So cash, 9,582, pretty steady. It was very high. You know, they've been especially high in 2008. Look at their current liabilities, pretty high for their cash position, and their current assets are pretty much equal to their current liabilities, which is strange. I don't know where they're getting this number from. Anyways, it's kind of weird here because they just have the notes payable and their payables, which are easily covered by cash, pretty much, and receivables, but then there's no data here where the 64,000 comes from. So that would require further investigation. Alright. Another interesting thing to note is if you go to key ratios, 10-year summary, average PE. So you can see their average PE for the last few years is around where it is now, which means you probably can't expect much of a capital gain from their PE. So overall, Exxon, it's looking alright. You know, you'd probably get a decent return from it, but you wouldn't get anything phenomenal. So let's go over to Yahoo Finance. And what Yahoo Finance is good for, you can find a good profile of the company. And what it's really good for is this, competitors. So you click on competitors, and you see you have all these different companies, and you have their relative PE ratios. So if you look at BP PLC, if you thought BP PLC was in a similar company to Exxon, and it has such a low PE, you could check it out, you know. And if you look at all the rest of the company, and it's as strong as ExxonMobil and has a lower PE, that could be a good one to buy. So this is a really good way to compare competitors, see what they're like, and see if you can get a better deal than the company you're already looking at. You could spend a whole day just going from competitor to competitor to competitor, from industry to industry to industry, and looking at these and comparing them. So that's it. I hope it was informative, and I'll see you soon.